Home mortgages explained. A mortgage can be defined as a loan issued from a bank or other financial institution to a borrower in order to help the person or entity to purchase a home. The collateral for the mortgage is typically the home itself, meaning that if the borrower doesn't make monthly payments to the lender and defaults on the loan, the bank can seize the home and recoup its money. Mortgage loans allow the buyers to break up their payments over a set number of years, paying an agreed amount of interest on top of the principal balance. Mortgages are also legal documents that allow the home seller to claim the property in case the buyer fails to make their payments. It also protects the buyer by forbidding the seller from taking the property while regular payments are being made. In this way, mortgages protect both the seller and the buyer. After your request has been approved, your lender will use the property as collateral as stated earlier. The lender will take a lien on the property's title until you repay the debt, at which point they will release their hold on the title. Mortgage lenders primarily make their money through interest on the loan. The amount of interest charged is commensurate with the risk the lender takes. There are three main types of mortgages: conventional, government-insured, jumbo loans, also known as non-conforming mortgages, fixed rate, and adjustable rate. A conventional mortgage is a home loan that's not insured by the federal government. There are two types of conventional loans: conforming and non-conforming loans. A conforming loan simply means the loan amount falls within maximum limits set by Fannie Mae or Freddie Mac. The government-sponsored enterprises, GSEs, that back most U.S. mortgages. The types of mortgage loans that don't meet the guidelines are considered non-conforming loans. The U.S. government isn't a mortgage lender, but it does play a role in helping more Americans become homeowners. Three government agencies back mortgages: the Federal Housing Administration, or FHA loans, the U.S. Department of Agriculture, USDA loans, and the U.S. Department of Veteran Affairs, VA loans. Backed by the FHA loans are types of home loans that help make home ownership possible for borrowers who don't have a large down payment saved up and don't have pristine credit. FHA loans require two mortgage insurance premiums. One is paid upfront and the other is paid annually for the life of the loan if you put less than 10% down. This can increase the overall cost of your mortgage. Borrowers need a minimum FICO score of 580 to get the FHA maximum of 96.5% financing with a 3.5% down payment. However, a score of 500 is accepted if you put at least 10% down. USDA loans. So USDA loans help moderate to low-income borrowers buy homes in rural areas. You must purchase a home in a USDA eligible area and meet certain income limits to qualify. Some USDA loans do not require a down payment for eligible borrowers with low incomes. VA loans. So, the VA loans provide flexible, low-interest mortgages for members of the U.S. military, active duty, and veterans, and their families. VA loans do not require a down payment or PMI, and closing costs are generally capped and may be paid by the seller. A funding fee is charged on VA loans as a percentage of the loan amount to help offset the program's cost to taxpayers. This fee, as well as other closing costs, can be rolled into most VA loans or paid upfront at closing. Fixed-rate mortgages keep the same interest rate over the life of the loan, which means your monthly mortgage payment always stays the same. Fixed loans typically come in terms of 15 years, 20 years, or 30 years. Unlike the stability of fixed-rate loans, adjustable-rate mortgages, or ARMs, have fluctuating interest rates that can go up or down with market conditions. Many ARM products have a fixed interest rate for a few years before the loan changes to a variable interest rate for the remainder of the term. Look for an ARM that caps how much your interest rate or monthly mortgage rate can increase so you don't wind up in financial trouble when the loan resets. The amount you can borrow depends on several factors, including how much you're qualified for, depending on your income, among other factors, as well as what type of loans you have. Conforming mortgages have limits, while jumbo loans allow borrowers to exceed the conforming limits. Mortgage terms, or how long you have to repay a mortgage, varies. The most common term is a 30-year mortgage, which allows borrowers to pay over 30 years. Of course, borrowers can have a 30-year mortgage and pay off faster, which will reduce the total amount of interest you pay, but they are obligated to. There are also 20 and 15 years mortgages. Typically, mortgages with shorter terms also have lower interest rates. So while you end up paying more each month with a 15-year mortgage because they are pushing more towards principal, the total of your payments will be much less than if you spread it out over 30 years. Jumbo mortgages. Jumbo mortgages are conventional types of mortgages that have non-conforming loan limits. This means the home price exceeds federal loan limits. For 2020, the maximum conforming loan limit for single-family homes in most of the U.S. is $510,400. In certain high-cost areas, the ceiling is $765,600. Jumbo loans are more common in higher cost areas and generally require more in-depth documentation to qualify. The best mortgage type depends on your budget and financial goals. Some people prefer lower monthly payments, even if that means paying more in interest over the life of the loan. In that case, a 30-year mortgage is likely the best option, whereas others might be able to afford bigger monthly payments and want to minimize the amount of interest they pay, which will make the 15-year mortgage a better choice. The perfect time to get a mortgage depends on the person's schedule and financial situation. The first step in getting a mortgage is to get pre-approved, and it's best to do this before you start looking at homes. A pre-approval might reveal you need to work on credit issues or pay down debt, So it's best to speak to a lender as early as possible to identify and resolve potential obstacles. Variable rates usually move in the same direction as the federal funds rate, so adjustable rate mortgages will be affected. The federal funds rate, however, doesn't directly affect long-term rates, which include financial products like 30 years fixed rate mortgages. Those tend to move with the 10-year Treasury yield. The end. Thank you.